I will sit down with a lot of realtors or people that are self-employed for that matter that have set up a PLLC or they've set up an LLC and they haven't taken that next step, which is letting the Internal Revenue Service know that you would like that single member LLC or PLLC to be taxed and treated as an S corporation. So that's a very important piece of this that needs to get done. The PLLC, LLC part of this, if that's already been completed, of course, we've got that protection factor that we talked about in the beginning, but the bigger part of this is setting it up properly with Internal Revenue Service, because they do not recognize LLCs and PLLCs as a separately taxed entity. So there is an additional tool that needs to be done in conjunction with this. So we can talk a little bit about that. And then we'll talk about how my firm operates, what are the benefits, because everybody out there probably has a tax guy or has a finance guy, and we'll talk a little bit about how my firm is set up differently for your guys' benefit. So the first thing that we'll discuss here will be the audit rates. I think this is important to point out for people that are filing as a sole proprietor. You've got a Schedule C that you file inside of your tax return, and our clients always want to know, why is the IRS after sole proprietors? And I think the simple way to sum this up is, when we have a client that has a Schedule C that gets audited and the IRS overturns expenses or discovers additional income that should be put into that schedule, what we find out is not only does the client owe additional tax on that, but they also owe self-employment tax, which is about 15.16% of that audit discovery. So we always look at this as, the Internal Revenue Service is obviously not the government. They are a third-party auditing and compliance type of service for the U.S. Treasury. So I think if they're going to waste their time or spend their time going through an audit, if they know immediately, if they are to uncover something, that there's an additional 15% in those findings, I think that is probably one of the number one reasons why they really target the Schedule C, the sole proprietor type people. The audit rates for a Schedule C happen to be 10 to 12 times, sorry, I forgot the S, they're higher for Schedule C than they do for an S corporation. As a matter of fact, as a firm, in 18 years, we have not had to represent one of our S Corp clients through any type of audit or discrimination. I can tell you that probably 90% of the audits that our firm gets hired to represent are people that are filing as a Schedule C or a sole proprietor. So I would tell people that the protection factor of the LLC and PLLC are a huge thing. The other part of this is, if I have the chance to file some additional paperwork, do a little bit more on the accounting side, and can almost eliminate my chances of being audited, I think that those two things combined, without even getting into the tax savings piece of this, would be enough to create that PLLC. This was some statistics that I had pulled through some of the different IRS bureaus as far as how they view S Corps, what kind of the statistics are as far as them even looking or trying to open up an audit on S corporations. And basically, when we talk to people at the Internal Revenue Service that represent the audit team, they come right out and tell us that S Corps they're basically off the radar. They don't have the manpower to venture over to the corporate side, especially when we're talking about smaller S Corps of $5 million in annual gross revenue or less. They really kind of keep these things off. So with that being said, the S corporations are really the industry standard. They are the way that we point our clients once they reach this particular income threshold that we'll talk about. Once we get to that threshold, we really push our clients to come out of that sole prop world and over to the side of the S corporation. I'm going to pull up a couple of kind of mock tax returns that I'll flip back and forth between the two because I want you to see the comparisons of these two. I picked out just a generic adjusted gross income number here of 75,000. So this is a realtor that maybe you make $100,000 of gross revenue, and we deduct expenses, mileage, super lockbox, advertising, all of these other things that are associated with what you folks do, and we get your net down to $75,000. So this first tax return that I'm showing you would be, of course, I've named the tax return Mr. S Corp. So this is somebody that has taken our advice as a client. We've created the S Corporation. They have $75,000 worth of net income. I'll explain to you just a bit about how we separate the two as far as wages, and then the other part, the $50,000 that flows through from the S Corp side. But the key points that I want you to look at would be at the very bottom of the page on the left, the adjusted gross income. This is what the lenders are looking at. This is when you apply for a loan. Everybody's concerned about what's your adjusted gross income, not taxable income, not wages, not anything to do with deductions, any of that stuff. They're talking about the very bottom line on the left, your adjusted gross income. So in this tax return, you can see it's 75,000. Then if you flip over to the page on the right hand side and just look at the total tax there that's due, I will flip to the next slide so that you can see a comparison of somebody that were to file the same exact income, but they did not take our advice and they are still filing as a Schedule C or sole proprietor. So we look at that $11,895 number, and then I roll here to Mr. Schedule C. So you can see the $75,000 is their total income still. But when we drop down to the bottom left, you can see the adjusted gross income is actually less. So this is important for people if they're just a few $1,000s or they're just off on debt to income ratio, because the mortgage lenders are not going to factor in this phantom deductible amount of half of the self-employment tax. So you can see, in fact, that the self-employment, that deduction lowers your adjusted gross income. But then when we roll over to page 2, you can look at the total tax liability on this one, $9,272 difference because of the self-employment tax for somebody filing as a Schedule C versus filing as an S corporation. The numbers are relative in the form of, if I took the $75,000 of adjusted gross income down to a net of $25,000, the bottom line savings, instead of the example that I have here, the $9,272, it drops down to about $3,369. So a couple things. I'm going to roll back to the S Corp slide here. So we can obviously see that that adjusted gross income number is a little bit higher, but yet the tax savings or advantages of it are much more significant. So this, us being an accounting firm, is the number one reason why we steer people towards this S Corp election, is simply people hire us to do the accounting to save them income tax money. There is a couple of steps that need to be done in here. And I think when you look at the tax return and you see there's 25,000 of wages and 50,000 of what we call pass-through income, clients will ask us, how did we determine that number? I know we're working with net of 75,000, but how did we arrive at 25 and 50 in this situation? And the math behind this is something that the IRS will not give us a definitive number on, except that there does have to be wages. We cannot push everything through into the S Corp pass-through income. So the $25,000 number does have some payroll taxes that are due with it, but the $50,000 has no payroll taxes that are due with that amount. IRS has simply given us guidelines, sort of in closed door meetings, to say, well, we would really expect that the revenue that we would see that would pass through in wages versus the total revenue that an S Corp would bring in. They give us a ratio of somewhere between 15 and 25% is what they would really like to see. We pick 20%, and that's sort of what we run across the board with all of our clients. Is if we have a client that has 100,000 net, you're going to see, 20, and you're going to see 80. I've done the examples in here a little bit drastic, where we're actually taking a little bit more in payroll, but I did this and pointed the examples out because I just wanted people to see the savings between the two filings, so we can break it down however. But like I said, the math kind of stays the same. If I reduce this down to 25,000 from 75,000 a total net, that savings drops from 9 down to about $3,000. So I think that's huge. Again, this adjusted gross income number, sometimes our clients are in a situation where they need just a little bit more income to qualify, and that self-employment deduction that you can see on the bottom left of this particular tax filing situation is going to drop that adjusted gross income number down. So I can get these slides out to you when the presentation is done so that you can go through these, because I know that it's boring or difficult to take notes on the tax returns. But I just wanted to point this out because I think it's a huge example of why people need to go this route. So we talked a little bit about adjusted gross income. The AGI will actually be lower on a Schedule C due to that self-employment deduction. I had mentioned in the beginning that there's an income threshold that when we're working with clients that are just starting out in your industry and maybe they don't expect to have a whole bunch of net income in the first year. They have a year, there's not a lot of deals that are going to close through. People will always ask me, what is that number that we're looking for, where we're going to take the additional steps to file the paperwork with Internal Revenue Service to become that S corporation taxed entity. And when I run the numbers from a cost of accounting and a cost of filing, that threshold that we've really picked out is $10,000. So if I've got a self-employed client that is going to go over $10,000 of net income in a year, it makes sense in that year to definitely make this S Corp election, because the self-employment taxes on $10,000 are over $1,500. And the reason why at my firm that we sort of push people in that direction is because when I add up the fees to file a corporate return, to file all the payroll returns that need to be done, the 4 quarters of payroll, fill out the W-2 paperwork, the W-3 paperwork and everything, it's less annually than that $1,500 for the total filing requirements based on the compensation that my firm bills for this. So that, that it may be different, right? When we're talking about other accounting firms out there, we've seen some of the S Corp tax returns that other firms are doing. They have a $2,000 minimum that they bill just to prepare that return. So obviously, if you're working with a firm that has a little bit higher on the billing side for those entity returns, and the threshold for this is going to be different. But it's typically 15.14% of net income. So on that 10,000, that's that 1514 number. That when we get a client that goes to that at 10,000, it makes sense for them to file that additional paperwork so that they can now be taxed and treated as an S corporation. So we've talked a little bit about adjusted gross income and actually raising that AGI for somebody that's trying to qualify for a home. Talked about paying less in taxes on higher AGI. But one of the big things that a lot of accounting firms won't talk about when they're preparing taxes is some of the planning tools that are in place for people that are filing as LLCs, PLLCs, taxed and treated as S Corps. There are pension type plans that we can create. So these would be things if you were ever an employee somewhere and you were part of their deferred comp or part of their 401k. There's a time where now the adjusted gross income switches over. Now we're making more than we really need, and we're talking about being able to shelter money. We're talking about tax saving strategies from an investment standpoint that can really save you tax money from lowering adjusted gross income. So when you're working as an employee for somebody, you have the ability to put $18,000 away. The company has the ability to put some additional money away for you, but the total that can basically be deferred in compensation is just a little over $50,000. But when we are dealing with some of our S Corp clients that are having good years, whether it be every few years, or now we're talking about consistent income being up into a point where they are not wanting to pay the taxes on all of the compensation. They're just not utilizing all of it out of the bank or what passes through the tax return. So we're looking at ways to shelter income. At my firm, we create these defined benefit deferred compensation plans for S Corp owners that are very similar to a company's 401k structure. But you can see on this next number that I put up, if you're an employee and we have the ability to tax shelter around 50 something thousand, as an S corporation owner, this number goes up over $270,000 that we can absolutely defer. And if we think back to the way that those tax returns looked, you could simply have a client that has $300,000 of net income, and we have been able to shelter almost all of it. The adjusted gross income would drop down by that 270, and we could in fact have somebody with adjusted gross income of only 30,000 that year because they've moved everything over into a defined benefit or defined contribution plan. So these are limits that are much higher than people are going to get if you're a sole proprietor and you've created, maybe something called a solo 401k where you're the company and the employee all in one, and they still have those limits as far as that $50,000 amount to be able to shelter away. So this obviously isn't for everyone, but we all hope that we get to a point where we can in fact be able to shelter this much money, and these are some of the only tools that we can utilize to do that. So these are things that at my firm we really will stress to people as far as getting set up. It does not need to be something where somebody is making a commitment to shelter that entire amount. We do not pick a specific amount, and every year it has to be funded. We simply wait until filing time to see where somebody's at. The other thing that's really nice about these plans is I can meet with our S Corp clients in February or March as we're completing the year-end tax return, and we can talk about depositing money into these defined compensation plans, and they do not actually have to be funded until September of that year. So they're good to be funded on the corporate and the personal extension. So I always think about the example of sitting down with a realtor client who knows that they've got a couple of very big deals that'll be closing throughout midsummer, but we're talking about preparing a tax return in February or March, a few months prior to that. They may not have the compensation to be able to fund that. We can simply file an extension, see if in fact those deals do close up, and we've got this additional money that we can shelter and put away. As long as we get these plans funded by the middle of September, they're good to go retroactive back for a year. So like I said, this might be something that you guys may already have all the things that we've talked about from an accounting standpoint in place. Your accountant's got you set up as an S Corp and everything is perfect, but maybe you've never heard about some of the things that we're talking about now from the defined benefit deferred compensation plan. And that's typical with accounting firms. Usually what you'll find is the accounting firm does the accounting, and they will tell you to talk to your financial planner about financial planning, and maybe the two of them are not on the same path, and you're not getting the proper education that you should. So that was really what my firm was built around when I put this together 18, almost 19 years ago. Was I said there needs to be something that bridges the gap between the financial planning industry and the accounting industry, two people that are on the same page. And so the firm was created, and we in fact do all of this inside of the firm, which I think is a huge benefit for people to be able to make sure that their finances and their accounting are on track and on pace with each other. I had talked about that annual requirement back in the beginning with filing with the Arizona Corporation Commissions, the fact that Arizona only has this one-time obligation to them to get this set up, and then there's no more annual filing requirement. For instance, in California, they do charge about $650 a year to keep that LLC or PLLC in place. Arizona just has this one-time obligation to do that. I think that there isn't a reason really, if we're able to create the LLC or PLLC for somebody, if you're planning on being self-employed for a little bit, you should definitely be looking into creating that, just because there's no annual cost to do it. We'll pay the fee one time, we're good, up and running and going. The other thing that I wanted to point out in wrapping this up is, if there is anybody that's listening today that is a sole proprietor, they've been filing as a Schedule C, but they've had an LLC or a PLLC in place for a few years. Maybe you've set this thing up 3 or 4 years ago, and no one ever talked to you about the benefits of the S Corp filing. The IRS about 3 years ago actually changed some of the statute as far as filing on this. And what we have the ability to do now is go back 3 years for somebody that had created a PLLC or an LLC but had not taken that next step to be taxed and treated as a separate entity. As long as the PLLC or the LLC date with Arizona Corporation Commissions or the other state that you may be filing out of, that effective date is the date that we can go back and ask Internal Revenue Service to allow this S Corp election. And I can actually amend 3 years worth of tax returns and file these as an S Corporation owner. You'll have some late payroll. You'll have some late fees that are associated, but I can guarantee you that if we're working with somebody that is in the $20,000 worth of net range, the fines and penalties and things like that for filing some of this late payroll are much, much less than the tax savings that would come out of getting this thing turned back around and filed as that S Corp. So that used to be something we used to be able to ask for only 90 days of backdating. And then Internal Revenue Service about 3 years ago changed it and said, in fact, we're going to make this retroactive back. We can go back 3 years. So if somebody's already filed that 17, we can fix 17, 16, and 15 returns right now. There are some 2014 tax returns that we can fix. But again, this has to be people that have already filed that LLC or that PLLC paperwork. If you are listening and this sounds like something that would be a good fit for you in wrapping up the year, I can file the paperwork with Arizona Corporation Commissions today to get your PLLC and your LLC up and running. Takes about a week to maybe 15 days at the most to get this up and going. We then can ask Internal Revenue Service to tax and treat your income from that point forward. So if anybody's got some deals out there that may be closing towards the end of the year that are going to bump you up over that 10,000 and you do not have the PLLC or the LLC in place, we in fact can still get that done prior to year's end and then push quite a bit of the compensation over to the S Corp side. There is nothing that needs to change on your part from a banking type standpoint, if you're already a PLLC or an LLC, the banks do not care that all of a sudden now that we are being taxed and treated as an S Corp. There's a tax ID number that we would either get for you if you've had an existing tax ID number. We keep that, but nothing changes with the banking accounts or anything like that. If you haven't had a PLLC or LLC or tax ID number, then we would certainly start that up with the bank. We would switch the banking info over, because from an accounting standpoint, what we really like to see is that somebody's running all the income and deductions out of as minimal accounts as they can. So that's something that's important to point out. This next slide here, we've talked about this, how our firm operates, that realistically that umbrella is over both sides of what we do. The Dobbins Financials, the public accounting piece of this, the Dobbins Wealth Management is the investment advisory side. But our firm is all under one roof, all under one umbrella. The accounting, the taxes, and the wealth management are all done from the same exact team inside of my firm. So we're super passionate about what we do because we know that it works, and we would love to be able to answer any questions or take care of any needs that you guys have in the future. This next slide has contact information, all the dandy stuff as far as website, Facebook, Instagram, Twitter, and you certainly can get my phone number. My email address is Brian, BRIAN, @dobbinsfinancial.com. If anybody has any questions, please feel free to email me or give us a call. I'll be more than happy to answer questions. I hope I cleared a little bit of this up. Obviously, there's a little bit more detail to it that we can discuss, but the bottom line of this is if you can do something and get yourself off the radar from an IRS standpoint and save yourself quite a bit in tax money, and then have the ability to shelter up to $270,000 of income, I think it'd be crazy not to do it. People always ask me, how is your firm set up? And I will tell people that for the last 20 years, the Dobbins entities have all been S corporations for some of the benefits that we talked about today. So thanks everybody for listening. I appreciate it.
Great. Thank you, Brian. Do you have time for some questions?
I do.
Because we have bunches.
Okay.
So first off, I think anytime that we're independent contractors, we always want to know what we can write off, what we can't. So car payments and dinners out with clients and all of that, does that apply for the S Corp as well? Or?
It does apply for the S Corp. And the other piece of this that's big is the fact that there's a little bit more leniency on some things that are related to healthcare. We can in fact create some packages on the S Corp side that simply state that the company is willing to pay 100% for any type of medical costs that the employees would incur. And in fact, the employees are them and themselves all in one. They're both the corporation and the employee, but the documents that we put in place basically state that the employees and their families are covered underneath the corporate plan. So there's definitely more leniency on the S Corp side and a lot less scrutiny from IRS type standpoints. Of course, everything is legitimate and by the book, but there's definitely some caveats to the S Corp filer versus the Schedule C filer.
Okay, great. And also, what is the annual income that you need to be? It was $10,000?
Yeah, so $10,000 of net income. So if you're going to gross $10,000 and we're going to deduct $3,000 or $4,000 worth of expenses like advertising and auto and cell phone and the continuing ed fees, and we're going to get you down below that $10,000, then that particular year it does not make sense, because you're going to actually end up spending more in accounting fees to file the quarterlies and the annual S Corp return than what you're going to save in taxes. But that threshold is $10,000 of net income. So you could have gross income of 50, but a whole bunch of expenses and still have net income of 9,000, and it still doesn't make sense. So we're definitely talking about net income of $10,000 or higher before this strategy is gonna really benefit someone.
And do you know what the deadlines are for filing? You said quarterly?
Yeah, so the annual tax return for an S corporation is actually due March 15th. If we file a 6-month extension, of course that pushes us out to September. The reason why it's a month earlier is because when we file this S corporation return, it actually generates inside of that return what's called a K1, and that K1 is the income for a shareholder or member. That income has to be added to your personal tax return. So IRS wants those a month before the personal returns are due. And then when we kind of flip over to that payroll type quarterly return. So again, we deal with payroll in January, February, March, and then we've got that first payroll return or report that's due in April. And then we go April, May, and June, and then we've got the July, and then we roll through. We've got an October, and then the fourth quarter payroll is actually due in January, the year after that tax year had closed up. And that's, you think about when and if you were ever an employee for someone, you got your W-2s in January or the first part of February. So that's the requirements for this to get done. So if we set somebody up as an S corporation now, we got their PLLC or LLC accepted, filed that paperwork with Internal Revenue Service. We have a fourth quarter payroll return that's due by January 31st of 2019. And then their tax returns actually due March 15th of 2019. And then the personal has that April 15th deadline.
Great. So on your personal taxes, if you're filing as married, how is this affecting it?
So if you are married and you're the real estate agent or the individual that's self-employed, the self-employment calculation is based on your net income. It has nothing to do with your spouse unless your spouse is self-employed as well. And then we basically have two different calculations for self-employment tax. The benefit doesn't change because the tax savings that I had showed you today is self-employment tax. So if you've got a wage earner that's an employee that makes $100,000 and you've got a self-employed individual that's making $75,000, this tax return example I showed you is still applicable because the savings that were displayed in the slides is only self-employment tax. We've just eliminated that self-employment tax, so it would not have a negative or positive impact on married filing joint versus single.
Okay. So say you are married and both you and your spouse are realtors. And so do you need to create two S Corps?
No, you can actually have one S Corp, and then that one S Corp can pass the income back through to your joint tax return that you file. So you can have two sets of income as long as the industry is the same. If I had a self-employed welder and a self-employed realtor, I can't have one S corporation return. But as long as the industry, the item that the tax return is being filed on is in correlation. I've got some clients that one is a realtor and one is a property manager for multiple properties that they either manage and or own. I can in fact have one S corporation return for that because it's both real estate activities that are involved.
Do you know if there's what's the setup fee for this?
Yeah, so the setup fee, so what we charge as a firm, if somebody has no PLLC, they have no tax ID number, they have no paperwork filed with Internal Revenue Service, our firm charges $795. Again, that's a one-time fee, and that takes care of all of the fees that you would have with Arizona Corporation Commissions. So if I think of the steps of kind of doing this on your own, is you pay a fee to Arizona Corporation Commission to have them set up your doing business as name and actually form your LLC or PLLC. So there's a fee involved in that. And then what they say is within 45 days, you have to go out and publicly advertise this in some sort of newspaper article. So you'll pay to advertise that 3 times. And that $795 that we charge includes all of that. So we pay Arizona Corporation Commissions out of that. We pay our publishing company to publish that article 3 times. We get a client's tax ID number, and we file the separate paperwork with the Internal Revenue Service to make them taxed and treated as an S corporation. if I've got a client that's already set up their own LLC or PLLC years ago, and we just simply now need to file the documents with Internal Revenue Service, we charge $295 for somebody that already, again, has that PLLC set up. They've got their own tax ID number, but we just now need to take that additional step to get this thing looked at and taxed as an S corporation. Whether it's we're going back 3 years or we're making it effective today, we charge $295 to do that, to provide that service. And then once that $795 is done with us, there are no more requirements with us as a firm, except we're going to have an annual tax return that we would file for your corporation. We would have 4 quarters of payroll that needs to be taken care of, and that's how I talked about that threshold. That's annually less than that $1,500 that we had discussed, and I could definitely break that down for somebody if they needed to know that.
It's a fun question. Can you hire your kids?
You can hire your kids if they, and again, there's no exact age for this, because I do have clients that use their really young kids. I'm talking 2, 3, 4 years old as models for something that they do, like a logo or some kind of branding, and they do pay their kids out of that. If it's something above and beyond that, we have to make sure that obviously a 4 or 5 year old knows how to work a shredder or file or things like that, so they don't come right out and give us numbers with that. The other thing that I would tell people is that we have a lot of clients that their kids are definitely working for them. They hire the kids to do some sort of service, whether it's trash or custodial or filing or whatever it be, marketing. I think kids are building websites these days, but it's important to note that we now have the ability to pay our children up to $12,000 if they're under the age of 18. There's no FICA or Medicare, no payroll taxes for the kids, and you can in fact take the majority of that. You could take $6,000 of that money and put it into like a Roth IRA or a traditional IRA for those kids, and there's no payroll taxes. That of course lowers the parents' tax liability because they're in fact paying an employee, but the kids don't have to claim that income because we've now got this $12,000 standard deduction that is in effect for 2018. So I guess that's a long-winded answer to it. Yes, you can, but we would want to have some definitive roles that the kids did for the practice, right? There has to be some sort of hourly rate or monthly compensation or something with some roles that they're going to provide. But if we've got really little kids, then we talk about a $2,000, $3,000, $4,000, $5,000 fee for a modeling type shoot for advertisement, car wraps, things like that. So depending on the business, right? If you've got somebody that is making baby blankets or cribs or something, then it's easy to pull that off. If you've got somebody that's a welder, I don't know what you're going to do with their baby in an ad. So anyhow.
All right. Well, great. Thank you. We had a lot of very specific questions, and I would really encourage you to reach out to Brian through email and the contact information you have on your screen right now. There seems to be a lot of interest in this, so hopefully they will be able to reach you.
Sure. I'll be more than happy to answer questions and help out. That's what we do.
Okay, great. Well, this has been recorded and will be available on our YouTube channel next week, and I should be able to get it out to you all in email by tomorrow. And I want to thank Brian again for being here, and I hope you all have a great day. Thanks. Thank you.